Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Canada's inflation rate cooled more than expected last month. Data from StatsCan showing the consumer price index slowed to 1.8% in February, missing economists' estimates. Food and shelter prices also slowed, while gasoline prices fell more than 14%. StatsCan says the main driver of the slowdown in the inflation was the ending of the temporary sales tax break. The agency predicts it will likely affect March inflation data as well. Shares of BCE are trading higher. The telecom giant, along with CoreWeave and Cerberus Systems, will collaborate on one of Canada's most powerful data centers in Saskatchewan. The 300-megawatt facility will be dedicated to AI computing, and the first phase is expected to come online in the first half of next year. BCE plans to invest $1.7 billion and says the project has the potential to generate economic value of about $12 billion. BCE is the parent company of BNN Bloomberg through its Bell Media division. Shares of Dollar Tree are getting a boost. They're up about 3%. That after the discount retailer beat expectations for profit and same-store sales in its latest quarter. On the downside, the company gave an outlook for full-year sales that missed estimates. Dollar Tree says the cautious outlook is due to continued tariff uncertainty and the potential for higher freight costs tied to the war in the Middle East. And taking a look at the markets, a bit of a rebound today after the sell-off on Friday. You can see the TSX up by roughly 0.8% right now. South of the border, similar situation. All of them are in the green right now. The S&P 500 up by more than a point, the Dow by almost a point, and the NASDAQ by about 1.25. As the conflict in the Middle East enters its third week, markets remain on edge as effects from the energy supply shock threaten supplies of fertilizer and sulfur. But my next guest warns investors not to get caught in chasing commodity spikes. Joining me now is Tim Regan, Managing Director and Portfolio Manager at King West and Company. Tim, we don't want to go running today, do you? Is that what it is?
Yeah.
Thanks for joining us.
Well, thank you for
Thanks for running
me.
up here
Yes.
and joining us.
Yes.
But
I guess today when we talk about commodities, and commodities are just flying. We've seen these cycles before. Commodities are very volatile. Over longer periods of time, commodity stocks really don't create any value at all. So when you get surges in prices and the stocks go up with a 2 beta to the underlying commodity price, you can bet that pretty soon they'll come down. This time is no different as it was in 07, 08, as it was probably about 5 or 6 years ago. So what we're seeing is a big commodity cycle where the prices are flying. This is the time that you want to peel back and maybe not own them or watch what you own.
now, are you saying get right out, not own them, or just not buy more?
We're right out of commodity. I mean, other than oils, but we did have one mine, Lundin, that we sold back in, I guess it was early February. We sold it, it spiked up again. I think it's trading at where we sold it, but we made our money. And we've seen this game too many times in our history to know that, this time is no different. It won't last. Wait for the commodity cycle to peter out, then buy the stocks at the bottom.
Now, any idea what we're looking at for when it might peter out? Because, there's been talk that gold will keep surging.
Not a clue.
Or what you think will happen.
I mean, not a clue,
Yeah.
really, because no one really knows. But if you look at it, most of the stuff that's going on is geopolitical. So not just Iran, but maybe it'll be towards the end of the year when we have midterm elections in the States, and perhaps you'll get a different or a divided House in Congress, and maybe that'll alleviate some of the, fear trade going on. There's a lot of factors at play, as you know. So, this time won't be any different, so we're avoiding the commodities for now.
It's funny, I think sometimes we forget that, with the House and its midterms, and that really is a geopolitical thing.
It's huge.
They're our neighbors, but it's a big thing.
Well, does Trump get neutered? And if you look at everything going on today, what's going on? Well, not just Iran, but we have our trade talks coming up. Does somehow Trump try to resolve things so the Republicans have a shot at retaining the House and Senate? I don't know, but it seems that's his modus operandi.
And now you said you're still in oil, right?
Yeah, we have in our Canadian side, we have about 10% oils. We probably are a little underweighted, but oil is going to be a great business for Canada if we can actually, I guess if Mr. Carney, I should say this, actually comes through with his plan, it should be fantastic. Building new pipelines, pumping more oil south, it should be great for Canada.
Do you see a rising demand for Canadian oil after what's unfolded in Iran and the Strait of, more specifically, the Strait of Hormuz?
Sure, I've heard some statistics that it's risen a bit, but it just makes sense that we are an oil exporting nation with a ton of oil. The U.S. needs oil. It ships it in from the Gulf. They have a neighbor to the north that can just pipe it south. They have all the refineries that can refine our heavy crude. It just makes too much sense. So hopefully sense will prevail where politics sometimes doesn't.
Do you see Canada bringing in more refineries and companies that can maybe do the work up here, or is it still just easier to?
I mean, it could be. I mean, we could see some of that. But, I think I read yesterday the U.S. is just building their first new refinery in 20 or 30 years. But that's how much refineries were at overcapacity. And oddly enough, people don't realize this, but we're using less gasoline in North America than we were 20 years ago. Just because not just EVs, but the internal combustion engines are made better, and the driving, it's kind of flatlining. So do we need new refineries for gasoline? Probably not. But do we need terminals that can convert gas into liquid gas to export to other countries? Absolutely. More of that will come along. That's not a refinery, but that's an LNG plant, but definitely.
All right, let's get to some of your stock picks. First up, Secure Waste Infrastructure.
Sure. So Secure Waste is a company that was known as Secure Energy. Basically, what they do is they are an environmental services company. Their main business is wastewater in the oil and gas patch. They do some metal recycling as well. So they're really more of an environmental company. And now that's why they're called Secure Waste Infrastructure. We like it quite a bit because smart management, they are growing, they have a high return on capital, and it's a business that's not going to go away.
Yeah, with everything, I mean, all the talk, hopefully we'll see expansion with that.
Yeah, absolutely.
And see what happens with it. Okay, a couple more we want to get in before we run out of time. Sure. Smart centers.
Smart centers, great real estate play. Like every other real estate, or REIT, I should say, it's been knocked because of valuation in the last 5 years. But you have Mitch Goldhar, who's a great CEO, creates a lot of value. The yield's almost 7% right now. We think the company's worth $35. But the other thing people don't realize is they actually have a lot of zoning for condos above a lot of their retail. And a lot of that is even along the Eglinton LRT, various places all over Ontario. Some of these, they're just zoned, so they're not pumping money in for development today. And that can be worth a lot in the future once we get through the condo cycle. It's an option on what they have.
And not concerned from the commercial side, or are we and retail?
Retail, I mean, they're Walmart anchored. There's a lot more concern in COVID. Now that we're through COVID, people are back shopping again. Will we have a recession one day? Probably. Will people stop shopping? No. Will their shopping be curtailed? Yes. But, this is an enduring franchise. So we're not worried.
Let's sneak in one more. Allegion?
Allegion. Allegion's a company no one knows about, but you probably use their products every day. They're the world's largest lock and key maker. They do electronic locks. You probably got in the building this way. They're actually based out of...
I'm going to look when I walk out.
Yeah, they're based out of Ireland, and they were a spin-off in 2013 from Ingersoll Rand. And so they're a global company. As you can see here, the 1 year they're up, but their fourth quarter earnings came out a little light because of the residential lock and key making, but their core business is mainly commercial and other. And even with that, they'll grow their earnings by about 15% this year. So once again, another company, great enduring franchise, but one that no one's ever heard of before.
All right,
but you use their products every day.
Okay, I am going to look when I walk out the door. Tim, thanks very much for joining us today. I appreciate it.
You're very welcome. Thank you.
That was Tim Regan, Managing Director and Portfolio Manager at King West and Company. Coming up, inflation slowed more than expected last month. We'll get more on that after the break. Headline inflation fell to 1.8% last month, which was lower than analysts expected. Let's get more now from Michael Davenport, senior economist at Oxford Economics. And Michael, thanks as always for joining us.
Good morning. Thank you for having me.
Okay, is there one clear reason as to why it was lower than expected?
Yeah, not necessarily lower than expected, but there was definitely a clear reason why inflation eased last month, and that really had to do with base year effects from the GST holiday. So if you recall, about a year ago, the federal government brought in a temporary GST holiday for food, alcoholic beverages, as well as a few other products, children's toys, Christmas-related products like Christmas trees as well. And so that temporarily dropped prices for many goods about a year ago, and that temporarily boosted inflation, particularly in December and January 2025 and January 2026. Now, that GST holiday ran from mid-December 2024 to mid-February 2025. And so now that we're looking at the inflation data for February 2026, that's actually dropped out of the calculation. So it caused inflation for some goods, particularly food and alcoholic beverages, to slow sharply, really just a mechanical slowing from February compared to the previous month in January. And so that was really the key driver of inflation slowing so sharply by about 5/10 of a percentage point to 1.8% year over year in February.
So does this, with all that, does this make this number a good number or a bad number to you?
Yeah, I would say overall it's certainly a good number. I think even more importantly, what we saw was that core inflation actually eased by a little bit more than expected as well. Inflation excluding food and energy, so the typical measure of core inflation, slowed about 4/10 of a percentage point to 2% year over year. That's the lowest number that we've seen for core inflation in a while. The Bank of Canada's preferred core inflation measures, which strip out some of the more volatile components of inflation and also control for indirect tax effects. So they would also control for base effects from things like the GST holiday as well. Those also eased. And so what we've seen is sort of broad-based easing in core inflation over the last couple of months. That's certainly a positive development. However, unfortunately, the positive news on the inflation front is likely to be short-lived. We've already seen, of course, with the U.S.-Iran war, a surge in global energy prices. That's pushed up prices at the pump. Overall, retail gasoline prices in Canada are up about 12.5% in the first half of March compared to where they were in February. And so that's likely going to send inflation in Canada up to around 3% year over year in the coming months.
Yeah, we're seeing, month over month, gas prices were up 3.6%. And I imagine by the end of the month, somebody told me they filled up with premium at 205. So that dreaded two number is showing up again. What kind of an impact will that have if these gas prices continue?
Well, yeah, it's certainly going to have an impact. So the first place it's going to show up is in the overall headline inflation data. So as I mentioned, we do think that it's going to push headline inflation up to about 3% year over year in the coming months. We also have another base effect that's going to come into the calculation in April because of the removal of the consumer carbon price last year. That's been holding down Canadian energy inflation for about a year now. That's going to drop out of the calculation in April. You combine that with the increase in global oil and gas prices that we've seen over the last couple of months. And we're going to see inflation shoot up quite a bit here. The real uncertainty surrounds, how long will global oil prices and gas prices and other energy prices in Canada remain elevated? There's obviously still quite a bit of uncertainty about how the U.S.-Iran war will play out, how long disruptions to the Strait of Hormuz will last. And so that's really the key point of uncertainty right now that we don't know. What we've done is we've looked at a range of different scenarios to kind of gauge where inflation can head. What we found is that if overall oil prices, so Brent oil price remains around $100 per barrel for the next couple of months, that would likely cause Canadian inflation to rise above 3%. However, if Brent crude prices rise closer to $140 per barrel, which would be a pretty significant increase from where we are today, but definitely not out of the realm of possibilities, and were to stay there for a couple of months, we could see Canadian headline inflation surge to about 4% in the middle of 2026. And that would obviously have significant ripple effects for the economy, for financial markets, and implications for the Bank of Canada, for example.
And could that bring up the R word, recession?
Well, it probably not. The reality is that Canada's economy obviously is as a major oil producer. We don't have the capacity to necessarily increase oil production sharply in the near term. However, in general, higher oil prices do benefit oil-producing regions like Alberta, and they weigh on demand and consumers in particular in regions such as Ontario and Quebec, where the oil price shock really squeezes household disposable income. And so overall, we don't think that would likely push Canada into a recession. However, it would lead to much slower growth in the second half of this year.
All right. And of course, last question, Bank of Canada, we hear from them on Wednesday. Has this changed anything?
Hasn't changed anything for the Bank of Canada this week. We had expected the Bank of Canada would hold the policy rate steady in this upcoming meeting on Wednesday before the U.S.-Iran war kicked off. And we think that they are going to continue to do that. We don't expect them to make any change to the policy rate on Wednesday. We think they are going to likely continue to remain on the sidelines. I think we'll hear a lot from Governor Macklem about how uncertainty has increased, about how that sort of clouded the inflation outlook and the broader economic outlook. And it adds to other key pieces of uncertainty, namely trade policy uncertainty, other geopolitical events that have arisen over the last couple of months that the Bank of Canada has been hyper-focused on for quite a while now. So we think it's going to be another factor that keeps them on the sidelines. Our baseline expectation continues to be that the Bank of Canada will remain on hold for all of 2026. However, as I mentioned, the outlook for the economy, for inflation, and the Bank of Canada as well is quite uncertain right now because of the uncertainty surrounding the U.S.-Iran war.
All right, we have to wrap it up there. But Michael, thank you as always for joining us.
My pleasure. Thank you for having me.
Michael Davenport is a senior economist at Oxford Economics. Coming up, oil prices are fluctuating as the Iran war deepens, straining Gulf-dependent economies and setting the stage for shockwaves that could soon hit the rest of the world. More on that when we come back. The oil market has been roiled by the Iran war, with prices swinging wildly for regions most dependent on Gulf exports. The strain is already apparent, with wider global implications on the horizon. Bloomberg Originals has this report on the unpredictable future of oil.
We've seen thousands dead in Iran. We've seen U.S. service members killed and injured.
It was just an excursion into something that had to be done.
Beyond the humanitarian catastrophe, the Iran war has really highlighted the critical nature of the supply that the Persian Gulf provides of oil to the world.
Oil hits triple digits. Oil flirting with $120 a barrel.
It's a very oil-rich region. The Strait of Hormuz accounts for about a quarter of the world's seaborne oil trade.
As reports suggest Iran is beginning to lay mines in the Strait of Hormuz.
When you look at the map, you think, goodness, how did we ever get to a situation where we depended so much on this narrow waterway? The situation we're in right now is unprecedented. For years, we have always seen the Strait of Hormuz, that narrow waterway that runs alongside Iran, that is in that crucial oil-producing area. We've always known that was a vulnerable point, but it's never been closed off like this. And Iran's new leader says he wants it to remain shut.
The only comparable analog to this in recent years is the 2019 Al-Abqaiq attacks in Saudi Arabia, and this knocked out about 6 million barrels a day of capacity.
The key question here is duration. And every day that this goes on, it becomes closer to a crisis. To try to help, the International Energy Agency, which is calling it the largest supply disruption in the history of the global oil market, has announced a record release of 400 million barrels of oil from its emergency reserves.
We've heard President Donald Trump say that the war is near to an end.
We've already won in many ways, but we haven't won enough.
Karg Island. This is Iran's largest storage and bunkering facility within the Persian Gulf. If we see U.S. military operations targeting Karg Island, this would mark a major escalation. Targeting of the economic lifeblood of the country could spiral, and we could see even more intensified attacks on regional energy infrastructure within the Gulf. The Strait of Hormuz is important. Roughly 100 to 120 vessels cross this every day.
It's a very narrow waterway. It's only 21 miles wide. It's quite shallow as well. They can't actually close it without force, but what we've seen is that the violence and the threat of violence has kept ship owners away.
We've seen this result in extreme oil volatility over the last few days, even up to nearly $120 a barrel on the Brent global benchmark.
Back in February, the major Gulf producers were producing 20 million barrels per day. As of this week, our reporting shows that 6.7 million have been shut down.
This has immense downstream effects, primarily on fuel consumers, so airlines, chemicals, fertilizers, and then of course on the consumer, China, Japan, South Korea. The primary supply crunch will be felt within Asia.
Where the rubber hits the road, the real shortages, rationing, panic, queues, that has all been happening so far in Asia.
There are very limited bypass options for crude oil and LNG outside of the Persian Gulf.
Russia is set to gain from this conflict in some ways. We've already seen the US administration issue waivers to allow India to buy sanctioned Russian oil. Obviously, a higher oil price is good for Putin too. In the US, we're not looking at sort of supply concerns, but what you're seeing is the gasoline price jump because this is a global market, and so the price of oil is set globally.
Iran has really shown that it has the ability to impose asymmetric costs and pain on the global economy and on the Western allies.
The market doesn't appear to be pricing a long conflict. One thing that people would be really watching for is the idea that the US Navy would be escorting oil tankers. Now, obviously, this is not without risk, and it does mean putting soldiers' lives in danger in the name of letting oil travel freely. But that is definitely something that the market is looking out for.
Coming up, Prime Minister Mark Carney was in Oslo, Norway this weekend, meeting with the Nordic countries about security in the Arctic. That's next. Stats Canada says the annual rate of inflation dipped below 2% in February as the end of last year's federal tax holiday helped take some steam out of the yearly price comparisons. Inflation last month came in at 1.8% year over year. Economists were expecting a slowdown of 1.9%. Economists believe the data will likely keep the Bank of Canada on its path to hold interest rates when it comes to this week's meeting as it waits for a clearer picture. Housing starts across the country climbed in February. The Canada Mortgage and Housing Corporation says the number of houses being built rose 4.5% compared to the month before. The agency warns, however, that though new construction activity remains relatively steady, the overall outlook remains cloudy. It expects higher construction costs and trade policy uncertainty to weigh on housing starts in the near term. Alibaba shares are moving higher. The Chinese tech firm is reorganizing its artificial intelligence operations as it pushes to generate more revenue from the fast-growing sector. The company is creating a new unit called Alibaba Token Hub, which will combine its flagship AI model, consumer AI apps, and AI products. The overhaul is designed to better coordinate research and product teams while boosting the commercialization of AI services. And taking a look at the markets, good to see some green there. People taking advantage of the dip, buying some things maybe. Right now, we're looking at the TSX up by 0.85%. And south of the border, we are looking at another green day down there as well. The S&P 500 up by almost 1.25%. The Dow by 1.1%, and the Nasdaq by nearly 1.5%. Well, Prime Minister Mark Carney was in Oslo, Norway this weekend, meeting with Nordic countries about Arctic security. While the U.S. has made headlines recently about Greenland, leaders agreed at the meeting that Russia remains the greatest threat to Arctic sovereignty. Let's get more now from Ken Coates, Distinguished Fellow at the Macdonald Laurier Institute. And Ken, thanks very much for joining us.
Good to be with you.
Let's just ask about that. Russia remains the biggest threat. Just how much of a threat are they?
Excellent question. On an international scale, they're bothersome in the extreme. They know how to harass Canada. They send up fighter jets to fly up to the Canadian borders in the high Arctic, and that forces us to scramble our jets back and forth. If you were in Norway, they're an existential threat. Russia borders right onto Norway, and Norwegians live constantly with the threat of sort of Russian invasion. Finland even more so. So the Scandinavian countries feel this very, very seriously. In Canada, they're more of an irritant than a threat. I don't see the Russians invading Ellesmere Island or taking over Iqaluit or attacking Churchill. It's not going to happen. Certainly in the next little while. Russia's very fully occupied right now and stretched to the limits. So it's not a huge imminent threat. But basically, the reality is particularly in Canada, we've underprepared for the long-term threat of Russia. So if Russia's not a threat today, it could easily be one 5 years from now. And so it's pretty important we get our house in order. We've waited way too long. So good to see something happening now.
Now, with that having, it's a very more serious threat to Finland and then Norway as well, and us more existential. Could we work together, or will we have two very different ideas of what we think we need up in the Arctic?
I think so. I'm not sure how much Canada can contribute. We barely look after our own Arctic. In fact, we're quite deficient in that particular regard. It's not as though we can send over 1,000 troops. It's not as though we can send over a whole bunch of extra ships or anything like that. What we can do is collaborate on the supply side. Canada and Norway, Finland, Sweden have access to a whole bunch of critical minerals. They have the ability to create production capacity. And in the years to come, I got a feeling that the access to supply of critical minerals is going to be far more important than sort of the immediate military threat. Are we autonomous? Are we self-sustaining? Can we maintain our own high-tech industries? Are we dependent upon access to supplies from China or access to supplies from Africa or other places that are more vulnerable? And so I think one of the things that Prime Minister Carney signed in Oslo was an agreement to sort of a memorandum of understanding to actually collaborate with Norway on developing those critical mineral capacity. Canada is not as good as it used to be, but is one of the world's greatest mining nations. We have a lot of skills in dealing with indigenous folks, working on environmental protection, things of that sort. Norway, basically, and the other Scandinavian countries have left their mining industry sort of moribund for quite a while, like 40, 50 years of not really investing in mining because they had other activities going on. So they need Canadian expertise, Canadian experience in that regard. And I think we can collaborate on processing capacity, figure out ways in which within the sort of the friends of the Arctic sort of circle that we could actually make sure we have the capacity to develop these products and bring them to market.
So with the announcement by the government about the infrastructure they want to put in up north, roads and runways, is that enough, or is it a start?
It's a very weak start, and it's about 50 years too late. So the announcements, first off, they're announcements about projects to be explored. They're not announcements about projects that are going to be undertaken. There's not, there might be shovels in the ground this year for the Mackenzie Highway. That project's been on the books actually since the 1960s. So let's not pat ourselves on the back and make it look like we're moving quickly. That's only about 60 years later than we should have done it. The same with the other projects. They're very early stages. There's enormous amount of environmental assessments, socioeconomic assessments to be done. They're going to be extremely expensive. And people are talking about, say, $32 billion. Most of that money is going to be spent on American military hardware. Not very much of that is actually going to be spent on the ground in the Arctic. So we've got a long way to go to find the money to pay for all these things. And actually, once you build them, you have to maintain them. And so the idea of having the Arctic Security Corridor, which goes from Yellowknife up to Grays Bay and Grays Bay and on the Arctic Ocean, it's going to cost a ferocious amount of money for a very small population and, quite frankly, quite limited economic returns. So the North has a tendency to disappoint its promoters. We always talk about the idea of there's another El Dorado, another Klondike to be discovered up north, and that rarely happens. So we're a long way away from a situation where we're getting enough resources out of the North to provide sort of a sustainable economy or to protect our sovereignty in the region at the same time. So don't get too excited. There's a very good chance that if the situation in the United States calms down, or the situation internationally calms down, that Canada will forget these promises fairly quickly.
And we're almost out of time. Where would you like to see that money spent up there to get the best bang for the buck?
Well, we should actually put the sovereignty of our citizens first. The reality is, on the strategic side, we've done pretty much as we can. The North is almost indefensible in many regards. What we should be looking at is, are we providing citizens in the North with the same level of services in the rest of the country? Massive housing deficits, highways that are incomplete, airfields that are not up to standard, electricity, waste disposal. We've got so much work to do. Let's focus on completing Confederation and making it a complete country first before we start trying to save the world.
All right, we have to wrap it up there. Ken, thank you as always for joining us.
You're welcome.
Ken Coates is a distinguished fellow at the Macdonald-Laurier Institute. Coming up, layoffs, consolidation, streaming losses, and the rise of the creator economy are reshaping Hollywood's future. We'll take a closer look after the break. If you watched the Oscars last night on CTV, you might have heard a few jabs from host Conan O'Brien directed toward Hollywood executives about the future of the industry. This week's Bloomberg doc takes a closer look at how layoffs, consolidation, streaming losses, and the rise of the creator economy are reshaping Hollywood's future, raising questions about whether the industry is simply in decline or on the brink of extinction.
Hollywood is very much a factory town, and the widget that we make is entertainment.
Across the board, everyone is creative, from the directors to the writers to craft service. Everyone has a talent.
Some people come out here sort of on accident and find a place inside of the circus, and I think that some people are kind of called.
Pilot season, upfronts, awards campaigns. Hollywood moves in cycles. But now, the cycles have slowed a lot. It's a reset, and no one knows where the new baseline is.
If you spoke to the average worker in Hollywood, you'd hear existential dread. You've seen a pretty dramatic reduction in output, a lot of layoffs, fewer jobs. So it's just been a dark period.
Los Angeles has visibly turned into what I would call a ghost town.
Employment in California's motion picture industries peaked in 2016, but was decimated by the pandemic. And despite a surge in streaming, the actors and writers' strikes meant a massive loss of jobs that show no sign of coming back. Big tech disruption, mega mergers, and the looming threat of AI has left Hollywood in shambles.
What are you doing? You can't help these people. Are you insane?
I never thought this crap would happen in my lifetime. We're just in this inflection point right now where everything's converging. Not great economics, bad business models, audiences that are fragmented.
Have they forgotten what a star looks like?
I was just at a meeting on one of the lots, and to not be dodging around forklifts, it's astounding the lack of production that's going on right now in Los Angeles.
So here we are, we're inside of an empty soundstage, actually one of the larger ones. As you can see, production has left California.
The numbers tell the story. Have a look at total LA shoot days for 2024. Now look at 2025, it's down over 16%. Compare this to 2016, when shoot days were at their recent peak.
Some of it has gone to other states, but the majority of it has gone outside of the US to places like the UK, London, places like Australia, New Zealand, and other countries with more aggressive tax incentives.
Goldman Sachs foreclosed on Radford Studios, a very famous film studio in Los Angeles, because it just wasn't making the payments on its debt.
This is the story across the industry, and ultimately, the buck stops at the box office.
The movie business is really in a long-term stagnation, at least in terms of cinemas. People aren't going out as much to the movies.
The average American now goes to fewer than 4 movies a year. Just a decade ago, I think that was closer to 5.
Ticket sales were doing pretty good until, once again, COVID. And they never fully recovered, remaining nearly $3.5 billion lower than 2018. Sure, people don't leave the house anymore, but there's binge watching. That's got to be a bonanza, right?
This was an industry that had a decade-long boom fueled by the arrival of streaming and the growth of new streaming services, Netflix, Hulu, and Amazon, followed by Disney and Paramount Plus and HBO Max.
The idea then was like, let's spend as much money as possible on movies and TV shows so we can get as many customers and win this streaming battle.
That came to a crashing halt in 2022.
Everyone was losing billions of dollars, and then in 2023, you saw the strikes by actors and writers. And that was really a turning point because the studios figured out they could get by with a whole lot less. So they cut staff, they cut their spending on movies and TV shows.
You're in bad shape.
Yes, Hollywood is very fancy celebrities. There's a lot of very wealthy people who are very fabulous, but the people that I know, they are writers, they are producers, they're directors, they're grips and electricians, and they are trying to pay rent, and they're trying to keep food on the table.
Actually brought my own slate, so,
Oh.
There.
Yeah, that's okay.
In the last 25 years, I've done production sound for everything from broadcast news to feature films. Check.
And the Oscar goes to Whiplash, Thomas.
Thanks, Mike and Dave. I won the BAFTA and the Oscar for Best Sound Mixing for Whiplash.
Thank you.
Compared to the heyday, things have gotten pretty bad. In 2025, I had 10 union days of work. You could say that I'm a canary in a coal mine because when sound people aren't working, it means that nobody's working.
I'm a writer for television and movies. It's been very, very, very difficult. The industry you worked in changed fundamentally overnight. I've had to take a demotion and go back to working as an assistant, the level that I was at before I became a staff writer.
I went from being at the top of my career, and then all of a sudden the rug was pulled right out from underneath, not just me, but everyone I know. And it's heartbreaking. I've had to take a lot of step backs. I work part-time at World Market. You know, I got a seasonal job there during Christmas, and thank God they decided to keep me.
A lot of people are digging into their retirement savings. You have to live.
Amidst this ominous lack of work, major studios have been trending towards mega mergers for their survival, which, needless to say, isn't helping.
There's been one big deal after another. The companies that have done the big deals have generally suffered from a profitability perspective, but also just from a stock price perspective. And people are really worried about too much consolidation.
Well, in my point of view, I lose a buyer. You look at Netflix, you look at Warner Brothers, you look at Paramount, you look at Fox, they're all buyers. While Warner Brothers can still run as Warner Brothers always ran, I'm losing places that I can take content to. And then, of course, you have job loss as well. Then you have studios restructuring. It's a never-changing cycle.
What's eating you?
There's little doubt that the culprit behind all this change is tech.
You have a camera in your pocket with a phone. All this editing software is cheaper than it used to be. And AI should only accelerate this because it's just going to be much easier for people to make stuff. There's more content being produced and released than ever before. We're all exhausted by it, and that puts a tremendous amount of power in the handful of platforms that have audiences.
This is a profound period of change in an industry. It's not unlike maybe what newspapers have been through, radio.
Tech comes in and they break these existing models that have worked for decades. It's happened with Airbnb, it's happened with Uber. Money is flowing upward to a very concentrated point at the top. Everybody in the ecosystem, from the end user to the provider, ends up suffering. And that's what happened in Hollywood.
If you're under the age of 18 years old, the majority of what you watch is on TikTok and YouTube. YouTube owns over 13% of connected TV audience, which has grown year over year significantly.
Let's have a closer look at the data. Here's Nielsen's numbers for how much TV time YouTube has been grabbing from the streamers between 2022 and 2025.
Movies are no longer the center of Western culture the way that they once were. I think that that's pretty evident and apparent in a lot of consumer behavior.
The days of the A-list star system that carried the box office isn't tracking anymore.
There's no longer like the gatekeepers of Hollywood. That's the beauty of the technology that we're in right now, is like it kind of opened the aperture to allow anyone to create. Because some of those storytellers are so good, they're getting a lot of attention on YouTube.
The good thing is you can publish anything you want. The bad thing is you're not being compensated for it. It is a massive grind in order to monetize that. For every Mr. Beast that's out there really crushing it, there's a million other creators that are never being seen.
It's very lean in terms of how all these creators are actually getting stuff done.
He said, hey, stop playing hero. Nurse, she's not even on staff here.
One camera operator, one editor, maybe a production manager. There's no like sound person, there's no crew. And I think it's been a hard transition.
And even these scaled down productions could go the way of the dodo. AI's ever-evolving image creation is poised to remove the need for sets, cameras, crews, even writers and actors.
There is no way but forward.
I know a few managers that are driving Uber.
I've been struggling with a plan, to be honest.
Do I feel like this is the end of my career as an editor? I don't know.
There is some light at the end of the tunnel, and that is content remains king. Even though big franchises still dominate worldwide revenue, smaller budget films are hitting a sweet spot and finding big audiences.
The heart of the business will always be storytelling. So it's a struggle for the people who depend on these big budget movies, but really an opportunity for people who are creative and get creative about the tools they use.
I believe that independent film is the beating heart of Hollywood. People are creating and they're making things, and there's movement. I am getting more business inquiries than I can keep up with right now. And to me, that indicates that people have a fire inside of them. They're not willing to let the business die.
The shift isn't theoretical. Companies like A24, valued at $3.5 billion, have demonstrated that disciplined budgets and bold storytelling can outperform the old studio playbook, turning indie films into box office wins and cultural touchstones. But studios are still doubling down on brand safety. In 2024, the top 10 highest grossing films were all franchises. 2025 saw even more expansion into pre-existing IP. If indies are going to make a dent, it's going to be because audiences demand it.
We need to make less Marvel movies. We need to make more great movies, great stories.
It's going to be smaller. I think it's going to remain a scrappy industry where people who are really passionate about it are going to continue to create opportunities for themselves.
People are still reading, people are still optioning, people are still taking in content.
As long as we keep doing our job and are given the opportunities to create at a high level, I do think that it will still hold an important place in culture in the long run.
All right, when we come back, we'll take one last look at the markets before we go. Market Call is coming up next. Today on the show, we have Teal Lind. He is the founder and chief investment officer at Lind Equity Fund, and we'll be taking your questions on North American stocks. All right, let's see how the markets are doing midday on a Monday on Bay Street and Wall Street. First up, TSX. You can see it's in the green right now. People looking for some deals right now and a little bit of relief, I imagine. Oil has dropped a little bit. Right now, TSX Composite's up by 0.8%. Can we pull up oil? What's oil sitting at right now? It was down last time I checked, but with everything that's going on, yeah, still down by 3.4%, down around 95 for WTI, and but it's going in a downward direction. That has some people relieved, everything that's unfolding in the Middle East. Let's take a look at a couple of the movers here. First up, a gainer, Altus Group. It is up right now and up about 11%. It's having a good day on the news that it's planning to launch a repurchase program to buy back up to 200 million Canadian dollars in shares. They'll do it through a modified Dutch auction. $42 to $52 a share is where they're at. And quick look at Nutrien. It is off over fears that the fertilizer market may be overvalued right now with everything that's happening in Iran. It's off by about 6%. And that is it for Morning Markets. Thanks very much for joining us. We'll see you back here tomorrow.